NASA would never launch a rocket without a system, so why are you investing like one? No checklist. No calculations. Just guessing, reacting, and hoping it works. That's exactly why most people make money and still feel stuck. The issue isn't effort. It's that your financial decisions are emotional, scattered, and unstructured. NASA removes uncertainty before liftoff. Investors? They jump in first and think later. But once you apply this level of thinking, everything changes. Your risks get controlled. Your decisions get sharper. And your money finally starts compounding with purpose. Stay with me. Because the first principle NASA uses is the one mistake costing you the most money right now. He doesn't touch a single dollar until he knows exactly where it's been. Sounds intense? Yeah, but that's how real control in personal finance starts. Instead of guessing, he runs a full audit like a pilot before takeoff, tracking income, fixed expenses, and those sneaky leaks that quietly drain cash. Most people skip this step and jump straight into how to make money, but without clarity, even good finance tips fall apart fast. Think about it like Tony Stark in Iron Man. He doesn't just build the suit and hope it works, right? He tests every system, every detail, over and over. That's financial psychology in action. For 30 days, he tracks everything: rent, subscriptions, food, even those late-night impulse buys. Apps like Mint or Anab help, but even a simple spreadsheet works. This is where strong money habits begin, not with investing, but with awareness. Here's where it gets real. Most people underestimate how much they leak monthly. Someone earning $3,000 might be losing $300 without even noticing. That's $3,600 a year. Imagine investing that instead into something like an S&P 500 index fund. Over 10 years, with average returns, that could grow past $50,000. That's not theory, that's financial education applied with discipline. Small leaks today become massive missed opportunities tomorrow. So he pauses, reviews, and gets brutally honest with the numbers. No emotions, no excuses, just data. Because once clarity kicks in, confidence follows. And here's the twist most people don't expect. Knowing your numbers is powerful, but without a clear direction, you're just moving money around without purpose. And that's exactly where the next step changes everything. He's no longer guessing, no longer reacting, now he's choosing a direction. Because here's the truth most people ignore: if money doesn't have a mission, it disappears. One month it's saving, the next it's spending, and suddenly years go by with no real progress. That's why in personal finance, clarity isn't just about numbers, it's about purpose. Is he chasing freedom, building income, or stacking long-term wealth? Think about Breaking Bad, not the illegal side, but the psychological shift. Walter White didn't just want money. At first, it was survival, then control, then legacy. The mission changed everything about his decisions. Same thing here. When someone locks in a 3 to 5 year financial target, like building a $100,000 investment portfolio or creating $2,000 per month in passive income, every financial move starts to align. That's financial psychology working in your favor. Now it gets practical. If the goal is freedom, he might focus on assets like dividend stocks such as Coca-Cola or ETFs like VTI. If it's income, maybe side hustles, freelancing, or digital products. If it's long-term wealth, consistent investing and compounding take center stage. The key isn't doing everything, it's choosing one primary target. That's one of the most underrated finance tips people miss. Focus creates momentum, and momentum builds results. And once that mission is clear, something interesting happens: decisions get easier. Spending becomes intentional, investing becomes strategic, and distractions lose power. But here's where most people mess up next. They set a goal, but they treat risk like a gamble instead of a calculated move. And that's exactly where things can either accelerate or completely fall apart. He doesn't ask, "How much can I make?" He asks, "What can I lose, and can I survive it?" That single shift separates disciplined investors from emotional ones. In personal finance, most people chase upside and ignore downside, and that's how one bad move wipes out years of progress. Real finance tips aren't about hype, they're about protection. Because if one mistake can break you, the risk is already too high. Think about The Martian. Mark Watney doesn't take wild risks just to get home faster. He calculates every move based on survival first. That's exactly how strong money habits are built. Before investing, he makes sure that money won't be needed for at least 3 to 5 years. Emergency fund locked in, debts under control, cash flow stable. That's financial education most people skip, and they pay for it later. Let's make it real. If someone invests $10,000 but might need that money in a year, that's not investing, that's gambling with pressure. Markets fluctuate. A 20% drop isn't rare, it's normal. Now imagine needing to pull that money during a dip, that's a guaranteed loss. But if that same $10,000 is left untouched, historically, markets recover and grow. That's financial psychology, patience beats panic, every time. So he builds a system where losses are survivable, not devastating. He protects his downside like an engineer designing a spacecraft, fail-safes everywhere. Because confidence in investing doesn't come from hoping things go right, it comes from knowing they're okay if they don't. But here's where it gets even more interesting. Even with controlled risk, relying on just one path can quietly put everything at risk, and most people don't see it coming. He doesn't bet everything on one path, because that's how people lose silently. In personal finance, relying on a single income stream or one investment is like flying with one engine and hoping nothing goes wrong. Strong money habits are built on layers, not luck. That's why smart finance tips always point to one thing: diversification with intention, not fear. Think about Interstellar. Every mission had backup plans, alternative routes, and contingency systems. That's not overthinking, that's survival. In financial psychology, the same rule applies. He spreads risk across assets like index funds, real estate REITs, maybe even a side hustle generating extra income. Not random moves, but calculated distribution. Each piece has a role, each one supports the mission. Here's a practical breakdown. Someone earning $4,000 per month might build 3 layers: a primary job, a side income bringing in $500 to $1,000, and investments growing quietly in the background. On the investment side, instead of going all in on one stock, he might split between ETFs like VOO, dividend stocks like Johnson & Johnson, and maybe a small percentage in growth plays. That's how to make money without exposing everything to one point of failure. And over time, this creates something powerful: resilience. If one stream slows down, the others keep things stable. That's real financial education in action. But here's the part most people underestimate: diversification alone isn't enough if you go too big too fast. Because scaling without testing? That's where even smart strategies start to break. He doesn't go all in just because something feels right. That's where most people lose money. Instead, he treats every move like a test run: small capital, low pressure, high awareness. In personal finance, this is one of the most underrated finance tips. You don't need to be bold first, you need to be precise. Strong money habits are built by learning how an asset behaves before trusting it with serious money. Think about Top Gun, Maverick. They don't send pilots straight into impossible missions. They train, simulate, fail, adjust, and then execute. That's financial psychology at its best. He might start investing with $500 into an ETF like QQQ or test a side hustle on weekends before going full-time. It's not about speed, it's about feedback. Every small move gives data, and data builds confidence. Now here's where it clicks. Someone who starts with $1,000 and learns how the market reacts to news, volatility, and time will outperform someone who throws $10,000 in blindly. Why? Because experience compounds faster than money in the beginning. That's real financial education. He studies patterns, tracks results, and adjusts. Over time, that small test becomes a scalable system. So instead of chasing quick wins, he builds proof. Confidence isn't emotional anymore, it's evidence-based. And once that foundation is solid, scaling becomes natural, not risky. But here's the catch most people miss: even with a solid system, if you let emotions take over during the process, everything can fall apart faster than it was built. He doesn't check his investments every 5 minutes like most people do. That's anxiety, not strategy. Instead, he sets a simple rule: once a week, 20 minutes, no emotions, just numbers. In personal finance, this is where most people fail. They react to headlines, panic on red days, and celebrate too early on green ones. But real finance tips? They're boring, consistent, and data-driven. Think about Moneyball. Billy Beane didn't build a winning team based on feelings. He trusted the numbers, even when everyone else doubted him. That's financial psychology at work. He reviews performance, compares it to his goals, and asks one question: is this still aligned with my strategy? Not, do I feel good about this? That shift alone separates disciplined investors from emotional ones. Here's how it looks in real life. Every Sunday, he opens his spreadsheet or app, checks portfolio allocation, tracks returns, and reviews income versus expenses. Maybe his ETF dropped 5%, okay, normal. Maybe his side income increased by $200, that's a signal to double down. These small, consistent reviews build powerful money habits. Over a year, that's 52 intentional adjustments instead of random decisions. And something subtle starts to happen: emotions lose control. He's no longer reacting, he's responding with clarity. That's real financial education. But there's one final layer most people never reach, because even with data, discipline, and strategy, if your foundation isn't solid, everything you build can still collapse over time. He stops chasing what's trending and starts asking a deeper question: is this built to last? Because in personal finance, hype fades, but fundamentals stay. Most people jump into whatever promises fast returns, but strong money habits are rooted in stability. That's where real financial education shifts everything. Instead of asking how to make money quickly, he focuses on how to keep and grow it over decades. Think about the parable of the wise and foolish builders in the Bible. One builds on rock, the other on sand. At first, both structures look fine, but when the storm hits, only one survives. It's the same in financial psychology. Investing in solid companies like Apple or Microsoft, broad ETFs like VTI, or even real estate with consistent demand, that's building on rock. It's not flashy, but it's resilient. Now let's get practical. Someone investing $500 monthly into a solid index fund with an average 8% return could end up with over $750,000 in 30 years. That's not luck, that's patience and discipline. Compare that to chasing risky trends that crash after a year. One path builds wealth quietly, the other resets progress repeatedly. That's the difference between reacting and thinking long-term. So he commits to the long game. He understands that real wealth isn't built in spikes, it's built in consistency. And while others keep jumping from one thing to another, he stays grounded, focused, and steady. But here's what most people don't realize: once you combine all these steps together, something powerful starts to form, and that's exactly what changes everything. Now think about where you were at the beginning, that feeling of not fully being in control, of making money but not really building anything solid. And now, you've seen how real personal finance isn't about guessing, it's about structure, discipline, and applying the right finance tips with intention. The truth is, most people never develop these money habits, and that's exactly why they stay stuck. So let me ask you, are you going back to reacting emotionally with your money, or are you actually going to start thinking differently from today? Hit that subscribe button and turn on notifications, because if you're serious about changing your financial future, you can't afford to miss the next insights on financial education, financial psychology, and how to make money with clarity and control. This isn't about motivation, it's about transformation through consistent action. And the more you expose yourself to this kind of thinking, the faster your mindset starts to shift. Now, if you're ready to take this to the next level, there's something waiting for you. A practical system designed to help you organize your finances, build multiple income streams, eliminate unnecessary expenses, and develop the mental clarity to make better financial decisions under pressure. It's called Holistic Health. Nourish your mind, balance your finances, transform your life. This isn't theory. You'll learn how to create passive income streams, structure your weekly financial reviews, and build a powerful money mindset that actually sticks. Click the link in the pinned comment now and start transforming your finances today. It's your time. Check out the material in the pinned comment and take that first real step toward building a life where your money finally works for you, not against you.